Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm Professor Code at the Forex Super Model, and this is a video how we made plus 500 points profit trading oil in 24 hours. So we're going to run you through the thinking and the basic approach of a recent profitable trade. So we're talking US crude oil, and we're talking the trade basically was the Tuesday the 19th of the 1st 2021, and we chopped it out Wednesday the 20th of the 1st 2021, the next day in the Asian session. Right, and really, so let's begin then, and so we make some space. We had a situation where oil would look favourable, and this was a sort of amalgamation of all sorts of things coming together to create a good trading opportunity. So we had asset classes coming our way, and by asset classes we mean FX, equities, bonds and commodities. Right, so let's look at the nitty-gritty then. So we decided the background to this trade really was some FX flows and some noise and a general situation of alignment. So let's look at the starting point then. Right. So if you look at what the information we had Tuesday, so intraday Tuesday the 19th. This was when we hit the go button. So 2021. So this was intraday. This was about 0500 hours GMT. What did we know? We knew this. We knew yen, dollar, euro, pound. So we had plus 77 on the pound, plus 75 on the euro, minus 7 on the dollar, and minus 145 on the yen. So, and this was the driver. So we had a negative opposed driver in the yen, a negative rock in the dollar, and a positive mover in the euro, and a positive secondary driver in the pound. Right, so what we had there was that situation, and if you look at the flows as they sort of swing from intraday, intra-week, day, n-1 previous day, etc., then you can see the complexes move through the modelled gears. Now, this is important because when when you're trading long oil, which is what we wanted to do, in the ideal world you want a weaker dollar. So that is so we long US oil. We're looking for a sustained weakness in the USD, and we were starting to see that through the gearing in the modelling. So Monday, which was the 18th of the 1st, intraday, we had the dollar as the positive mover. And then Monday 18th of the 1st, the actual day, the whole day flows, the dollar was the positive rock. So we wouldn't have had the full day flows until the Tuesday effectively. So then we're into Tuesday data, and we can have a look at intra-week. So Tuesday the 19th of the 1st, intra-week, and the dollar was the positive rock again. And also Tuesday intraday, 19th of the 1st, intraday, the dollar was the negative rock. Okay, now, so that was our go point. That's when we started to go long oil, and this is off the back of. So if you look at our video on modelled gears, you can see that if it's a positive mover, this is positive second gear. Positive rock is first gear, positive first gear. So positive rock is first gear again, and a negative rock is first gear in reverse. So basically we were coming down the gearbox, you can see. We were in second on Monday, intraday. We came down to first throughout the whole day of Monday. So we basically we were slowing. The dollar was starting to slow. Tuesday intra-week, which was from the beginning of the week, the dollar was now still the positive rock, so we were staying in first. And then finally Tuesday intraday, we actually started to engage reverse gear. So we were minus the rock. The flows were starting to turn against the dollar, which is what we were looking for, and the dollar was so we were in first in reverse, if you like. And then on what have we got? Tuesday day then. So this was during the day, the whole day of the 19th. So this is the whole day. The flows were on the dollar. We were negative rock again, so we were still in first gear in reverse. And then Wednesday intra-week, the dollar was the negative secondary driver, so we were in negative third gear there. So the dollar was weakening quite nicely. And then Wednesday intraday, which is the Asian session effectively. So intraday, the dollar was the unopposed negative driver. So it was unopposed negative driver, and that's in full reverse, overdrive in reverse. And that's what we were looking for. So those were the flows. Now if you looked at our other video, which was secrets hidden secrets of moving averages or something like that. Secrets of moving averages that every trader should know. We suggested that if you're looking at first and second derivative changes, then you could look at them in a very basic manner from looking at the 100 EMA on the 2-hour chart. And if you look at the, let's have a look. If you look at the oil market, the 2-hour chart, and you put in the 100 EMA, you can see that you get this sort of situation here, and this point here is the inflection point. And this is the point where the curvature changes from this way to this way, and this is the go point. If you watch the video, you'll know what we're talking about, but this is the go point here. This is where the second derivative is 0 here, and then it starts to really ramp up. So that was the second piece of information that was quite useful to us. You can look at it just by eye, or you can do the maths. But you know, if you can identify the inflection point, which was here, and this coincided roughly with Tuesday the 19th of the 1st. So that was another point in our favour. So what else were we looking at? We were looking at the fact that there was two bits of fundamental stroke noise. So there was fundamental data stroke noise in our favour, and the fundamental data was China GDP came out. Whilst the fourth quarter was negative, overall China was the only major economy, it was argued, that had seen positive growth in the last year. So China was on the up, so there was a China growth story, and this was likely to be a boost to the oil demand, and we also had, on the noise front, we had the what's it called? The Keystone pipeline. Keystone pipeline, which runs from Canada to the US, and that there was negative noise. The incoming President Biden was supposed to be coming down against this project of the Keystone pipeline, and that we inferred would be in effect a restriction in supply, and therefore this would give us a price boost. So you know in economic terms you've got supply, and then you've got a contractionary shift in supply. So you end up with a higher price, basically. So price and quantity. So in terms of, you've got a contractionary shift in supply off the back of this potentially negative noise in cancelling the Keystone pipeline. So that was the other piece of the jigsaw. So just to summarise then, what did we do? We recognised the flows. So we identified complex flows, and the complex flows were bringing the dollar down, which was beneficial in terms of our long oil trade. So that was the environment. We were seeing the dollar come off. We were seeing an inflection point, which is the go phase for oil via the 100 EMA and 2-hour chart, and obviously we were looking at it from a mathematical perspective, but you can pick it up, you can infer it from the chart in that way. So that's 100 EMA, what was it, 2-hour, yeah, 2-hour chart. So basically you're inferring where the inflection point, or is where the second derivative, which is the rate of change, is 0 before you start a ramp up in the in oil in this case. The next thing was we recognised there was a contract rollover. So February crude contracts were rolling over to March, and therefore we recognise that the trading would be choppy initially, and that's why we went 20% long bias. We didn't just go long 100%, we went 20% long bias, and we actually incurred quite a bit of chop early on the Tuesday, and the trade swung around about 70 to 80 points, and then once we got through that chop and people started buying into the new contract in March, then we jettisoned the short sides of the trades and added to the other sides, and we ended up with about five times long trades, which, given that the oil market moved, an amount during that day, we multiplied that and ended up with a profit of in excess of greater than 500 points. So there's 4 things that we looked at really. We looked at the complex flows, which were showing that we're going to get a fall in the dollar. We looked at second derivatives via the 100 EMA on the 2-hour, if you like, showing that we were coming into an acceleration phase in oil on the up. We looked at the contract rollover, and we also looked at the fundamental situation, which was this sort of China growth story, and the negative noise on the Keystone pipeline via Biden's inauguration. So it all came together. We chopped it out for a number of reasons. We at that point we could have ridden it higher, but we chopped it out. Basically, to summarise, we chopped it out because of the uncertainty of this Biden's inauguration speech. He's quite likely to backpedal on this Keystone pipeline because it's causing havoc in Canada, and he won't want to upset Trudeau and their side of things immediately, in our opinion. So there was potential, and you're seeing a bounce in the CAD as we speak. So that is really where we are. So I hope that helps. That's the way we sort of work here at the Forex Super Model. We have an overall macro scenario which backs up the flows and the technicals, and the sentiment, if you like. It's all come together in that sort of situation, and we've managed to come away very nicely, thank you, on the right side. So see you again. Hope that was useful. Thank you very much.